know what, Greg? You don't have to worry about it from here on out because we are live on Facebook for the Tuesday edition of the Not Your Average Investor Show. And you don't have to worry about doing the maintenance things. Let me take care of that. I am the host, Pablo Gonzalez. You, as we all know, is the brilliant co-host, the Tony Romo of the Not Your Average Investor Show, Greg Cohen. Say hello.
Hello, everybody. Good to be here.
And today we have a guest that we have been really looking forward to for a long time. He's a close friend of Greg's, a close friend of JWB. He hosts one of America's top investing shows with 188 nations listening to him. Over 2 million downloads. I think he's nearing 3 million downloads is what he said. He can verify that in a second. He's an international best-selling author. He's been seen in Forbes, Business Insider, but not just that. He's been investing himself since 2002 with properties ranging from Alaska to Florida to Panama, where I believe he owns a coffee farm that I would love to hear more about. And he self-describes himself as a shaved mammal, but he's an expert in real estate and education. Welcome, Keith Weinhold. How are you doing, my friend?
Hey, terrific. Thanks so much for having me here. It's great to be on the Not Your Average Investor Show.
Great to have you. It's really great to have you. And it's really great to have our audience here. It's really good to see these recurring faces that keep coming back. Jake, good to have you back. Jane, Lee is here. We see all of our friends. Medj, good to have you back as well. I'm just kind of scrolling through. So Vinay, you're a V, so it takes me a while to get to you, buddy, but good to have you back as well. And for those of you who have not been here before, Tuesdays is where we sit down and we have a show like this, where we have an esteemed guest. We interview them about their experience in real estate and life and business and make it really educational. We highly encourage questions, and we're going to be getting through the interview. And as you start thinking about questions, we want you to pop in, but we also want you participating with each other. So if you hit that chat button and you hit that blue button that says all panelists, drop that down and make it all panelists and attendees. Now everybody can chat with each other. And to add a question so that I can ask it here of Keith, you got Keith right in front of you with Greg, hit the Q&A button and pop the questions in there. I try to track all questions, even though you put them in the chat, but I promise you, it'll make me short circuit less if you put it in the Q&A, and there's a higher chance that I see it and I don't mess something up, which I may do. Also, if you just want a primer on real estate investing, go to jwbwebclass.com. That'll be the what is rental income properties all about? What's the benefit for your portfolio? What are the best markets to do it in? What JWB really believes is the key differentiator in success and why they do it better than everybody else. It'll be a great use of your time. And also, Thursdays, like I said, we try to get to every question here, but we have an all Q&A show on Thursdays. That is at the same time, 12:30. You're already registered for it. That is kind of like our little social club where we have every regular that comes here. We answer any question we didn't get to today. We get to on Thursday, and we take a bunch of other questions. And we also run through an actual property, break down the numbers. It's really tactical and practical, the advice that we give on Thursday. So I would encourage all of you to join us on Thursdays for these calls. They're a lot of fun. Like Thursday, right around 11:30, I start getting really happy because that's about as much fun as I have each week, unless I'm surfing with Greg. But without further ado, Keith, it is great to have you here. I would love to hear about how you are not an average investor at all.
Well, like I said, I love the name of the show. You are not average. You don't want to be average if you're listening to this show. When I say you, I'm talking to the listener for the moment here. You did not wake up to be mediocre. No one, when they come of age, whether they get done with high school or trade school or college, says, I'm going to go out there and I'm going to live a small life and I'm going to make really small decisions that limit what I can do with myself. But yet that's really what almost everyone does exactly. So it really starts with not being average. I mean, look, from Henry Ford to Steve Jobs to Elon Musk, they didn't make ordinary decisions. They made world-class decisions. So if you want to live an extraordinary life and make an extraordinary impact on others, then you need to make extraordinary decisions, because not being an average investor begins with not being an average person, and therefore not living an average life. and instead having a life where you have an outsized impact on others and live a better life yourself. Now, I don't know that I've made any of those outsized impacts from some of those visionaries that I just mentioned. I probably haven't had as much time on this earth as them yet either, but I wouldn't ask someone to do something that I haven't done before. So when I was done with college, I moved to a place that I dreamed of living in. Now, I had lived most of my life in Pennsylvania, and after college, I moved to Anchorage, Alaska. It's not because I had a job there, it's because I had vacationed there 4 times, and that fit my interests for skiing and mountaineering. So already I'm really kind of putting happiness and what I really want in life above just sort of those everyday things that I have to do, like go to a day job. I made my first ever home of any kind, a fourplex building where I lived in 1 unit and rented out the other 3. That was way back in 2002 in Anchorage, Alaska. A pretty scary time for me, really. I bought a fourplex building in Midtown Anchorage for $295,000. And a lot of people say, well, I don't know how I would afford something like that. Well, actually, you don't have to. You just need to know how to. I bought that with an FHA loan and a 3.5% down payment because I didn't have a lot of money at the time. I was just sort of coming of age. But I knew that to get more out of life, real estate's made more ordinary people wealthy than anything else. I needed to make a world-class decision and buy a 4-unit building with a small down payment. In 2014, I quit my job and I launched a podcast. Again, a strange thing to do. I started off talking on a Anchorage, Alaska dining room table with a $60 USB microphone because I knew I had a message that a lot of people wanted to hear. So my point is that I'm not doing average things. You need to expand your means, not just live below your means and not live an average life. So look inside yourself and you need to regularly ask yourself, what are you doing that's world-class, that's not ordinary, and that's not average?
Man, I love hearing your story, and I love you weaving the name of the show into this. It's like, man, I never knew the show was so cool until you started sharing about that. But I got to tell you, so I've been in a similar space as you, right? I grew up a certain way and thought I was going down a certain career path. For me, it was this corporate America job that I thought I wanted. And then I had some big shifts in my life and, led me to building JWB and investing in single family rental properties. But, I'm not your classic entrepreneur. I'm not the huge risk taker. That's just not me. And so there were a lot of things and a lot of resources and a lot of people and a lot of books that came into my life that just kind of slowly, but then kind of created this mountain of force for me to, to take that leap, to do something not average. I would love to get inside your head a little bit prior to you leaving that job, which is such a huge leap, and going out on a risk and building your own podcast, which I can only imagine how many people told you like would never be successful, especially in 2014, to now knowing that you're, I think 3 million downloads. Talk to me about that transition for you and maybe how difficult it was and what helped you to make that leap to not doing something average.
Mark Twain said, whenever you find yourself on the side of the majority, it is time to pause and reflect. I need to keep making world-class decisions to get more out of life. Really, another one of Mark Twain's lesser-known quotes is, this is a great quote too, he said, go out on a limb, that's where the fruit is. So in differentiating oneself and trying to be different, well, when I still had that day job, I found people continually asking me over and over again, how do you invest in real estate? How do you have this income that keeps recurring without your involvement? Keith, how are you and your wife going on another vacation to Hawaii when we clearly can't afford to do that? So I was having these discussions over and over again with people, sometimes even having a small group in my office at one time. And I was sort of explaining some of these concepts like leverage and arbitrage and cash flow that are foreign to people. And it got repetitive. I loved helping people like that, but I thought, well, if I steer my words into a microphone, that way I can reach more people. So it really came almost out of necessity. And oftentimes in life, when you change systems or launch something new, it sort of is something that comes out of necessity. So that's really what facilitated the launch of the Get Rich Education podcast.
That's amazing, man. You've said so many things that resonate so deeply with me. Number one, Huck Finn is my favorite book, so I love Mark Twain. I moved to Jacksonville so I could surf, right? Like I've arranged my life around stuff that I love. And I've also realized that to gain leverage on your knowledge and your impact, you make content, right? And you know, I think you undersold the impact that you've had already, because we actually have Doug here who says, Keith is the man. Episode 6 of Get Rich Education changed my life. And that is the Get Rich Education podcast. You can find Keith at getricheducation.com, where you can download his free guide to, I believe you said, getting started investing in real estate, Keith. Is that what that is?
Yeah, dispelling a lot of myths about real estate investing. Yeah, making sure you don't make mistakes.
Perfect. And then Doug also followed it up with something that I wanted to ask you anyways, right? Like, you are a preeminent real estate educator, right? Like you've had so many reps at this that you have a very succinct, intelligent way to make the value of it land on people. So I would love to hear you talk about the 5 ways that real estate pays you.
Yeah, okay. I can get into that. There are a few numbers that are there. I think first, something I want to bring in, if I can, Pablo, to transition from not being an average person and not making average in daily decisions, is to not be an average investor. Again, this is a Not Your Average Investor show. And I think it comes down to, you can really differentiate it by poor, middle class, and wealthy. Just to use a broad generalization before we talk about the 5 ways, poor people work for money and they don't really have much of anything left over, and that's fine. They might make their own contribution to society. Middle class people, they get their money to work for them. They might have some money left over for a 401k or an IRA. And that's all. They think that the best and highest use of their investing dollar is to get their money to work for them. Well, I'm here to tell you, if you only try to get your money to work for you, you're not going to achieve wealth unless you have some fantastic idea like the next Facebook or something. Don't just get your money to work for you. Real estate investing enables you to ethically use other people's money. That is a paradigm shift for a lot of people. That is not being average. Well, now, how do you get other people's money to work for you? Is that legal? Is it even ethical? Why would you want to get involved with that? Well, sure you do. Just to take it back to that first fourplex building, because we're talking about real estate investing here on this show. When I bought that fourplex, or when you buy a turnkey property with a 20% down payment, you're ethically employing other people's money 3 ways at the same time, not just your own. That's a wealthy decision. How do you ethically employ other people's money 3 ways at the same time? The tenants for the income, the governments for generous tax incentives, and the bank for leverage with just a 28% down payment. You're using 80% bank money. So the takeaway is, don't focus on getting your money to work for you. If you don't want to be average, ethically employ other people's money to work for you. And that's really something that's threaded into the 5 ways that real estate pays you.
That's so good. And I'm glad you're talking about debt. I'm glad you're talking about leverage. You know, when I speak about this, I talk about how I am so fired up about finding smart, inexpensive debt that you can take out, buy assets that then pay for themselves every single month. And historically, if you give it long enough of a runway, are going to go up in value. And many people still hear that and they're still so scared. You know, I told Pablo this one of the first times that we were together and doing a show. We were talking about debt and we were interviewing another guest, and I said, I have hundreds of millions of dollars of debt. And he about fell out of his chair, you know, because it was still somewhat new at that point. And I'm so excited about it. And he's like, how can you look at that and wake up every single day and not just be a basket case? And what I explained was this: when you understand how the numbers work and how the model works, then looking for good, smart, inexpensive debt that's not over leveraged is the deal. Right? We talk about that, especially in an environment now where you have such low interest rates. We prep our clients to expect 4% interest rates when they're getting conventional loans. So this concept of being comfortable using debt responsibly is so much more important. I think so much wealth is going to be created right now by those who fully understand it. So can you talk about this dynamic where how important it is to get comfortable using smart debt, and maybe help some folks maybe shed some of those myths or things that hold them back from making an otherwise good decision?
And it's funny, we started the show about not being average, and I gave those examples of things I've done to not be average. But then as soon as I get concrete and you and I talk about something like $10 million in debt, that suddenly scares people. But remember, just 10 minutes ago, I had you nodding your head when you said you have to make decisions that are not average. So stick with us here. You know, you bring up debt. I've been known for saying that financially free beats debt free. Let's come up with one of those staggering numbers, Greg. Let's say that someone has $10 million in debt. Oh, that used to sound terrible to me. Like, would they ever get out of debt? I mean, are they just constantly in bank servitude? How do they get in that situation? That sounds awful. Well, first of all, the more you learn about how credit markets work, a person would have to be a pretty savvy investor and have a pretty strong financial balance sheet to ever get $10 million in debt. So let's think about it that way. And the way to make people more comfortable with debt is think about this. Greg, let's just use the example and say that you had $10 million in debt. Might sound good to me, depending on how you have $10 million in debt. I know that you're a savvy real estate investor, Greg. When the $10 million in debt, when those monthly payments are all outsourced reliably to tenants in several diverse geographic markets, you have a durability behind outsourcing all of your debt service to somebody else, while at the same time you get all the other benefits, all the other ways that real estate pays you, which we can get into shortly. And a lot of people aren't talking or thinking about inflation. You know, millennials and Gen Z, they've almost forgotten about inflation because they've always lived in a low inflation environment. Just looking at the inflation benefit of alone of having long-term fixed interest rate debt of say $10 million. I even did a podcast episode called The Debt Decamillionaire. Rather than being a decamillionaire and having $10 million in net worth, having $10 million in debt, with inflation alone, just say we have a 3% inflation rate, inflation debases your debt. So we know the tenant is already paying down that $10 million balance for you because they pay down principal. They also pay all of the interest on that. And they pay something in addition to that called cash flow. But inflation is simultaneously debasing your debt because if you have a 3% inflation rate, after 1 year with $10 million, now you only owe $9.7 million in real inflation adjusted dollars after 1 year, and 9.4 after the next year, and 9.1 the following year. You've got a $300,000 tailwind just from what I call inflation profiting, which is what I'm explaining here. And that's something a lot of people don't even think about. And we haven't even gotten into cash flow or leverage. So we're talking about being comfortable with debt when it's reliably outsourced to tenants and enjoying all the benefits. This is what we call good debt. It's not bad debt that's unsecured, that's at a 21% APR credit card. That's not what we're talking about here. Be a debt decamillionaire. It's actually pretty aspirational.
That's man, I feel so much better about myself now. But that's what it's all about. You know, investors, savvy investors look at the end result here, and the end result is getting assets, acquiring assets, you know, that bring positive cash flow, that go up in value over time. And when you look at that as the end goal, especially when I started at age 23, started to buy properties, I looked at this as sort of a race against time for me to acquire the assets. Now, taking on the debt is a part. It wasn't going to happen unless I got really comfortable taking on the debt to do it. So my choice was either to understand and master how debt worked. And if I did that, then there was no limit to the amount of properties that I could get into my portfolio. And if I got those properties, that right number of properties in my portfolio, then I could really create financial freedom for myself 10, 15, 20 years later. So in my mind at 23, I said, okay, well, I just got to master this debt thing, understand how to do it responsibly, and then I'm really in control of my own financial future. So if you think about it that way, it's something that you need to get comfortable with, and it unlocks this ability for you then to acquire the assets. Then debt doesn't have this, you know, ominous negative tone. It's a tool for you, which is, you know, I know how we both think about it.
Debt is a four-letter word, but it doesn't have to be. You don't have to think of it that way. And just to make things really clear for you, the listener or the viewer, you know, if someone's got $10 million in real estate debt, well, then there's a pretty good chance that in the asset side, they have more than $10 million worth of assets. If they've got $30 million worth of assets and $10 million worth of net, they have a positive net worth of $20 million. And I know that we're talking about some really big numbers. Not everyone can relate to that, but it all comes down to ratios. So get comfortable with debt, learn about debt.
Keith, you're such a pro, man. Like just listening to you navigate and express it, and it's so succinct, and the way that you're able to carry this conversation is blowing my mind. I love it. How do you go from being? I mean, tell me about what the real estate market and living in Alaska is like, and then being able to transcend that and invest in other places.
That's a great question. You probably rarely have anyone on your show that lives in the state of Alaska. Again, I think I told you I was born, raised, lived most of my life in Pennsylvania, moved here by choice to be intentional. With all that said, I think in general, of course, Alaska is a huge state, but this is a poor place to invest in real estate. I do not advise investing here. I live in Anchorage, Alaska, the largest city, a city of 300,000 people. So just to talk about Anchorage, the largest city, the economic center, we actually have the nation's second busiest cargo airport in Anchorage, second to Memphis. So, we've got some dynamics here you wouldn't think about, but we are so tied to and we are so dependent on the price of a barrel of oil. The Anchorage, Alaska economy is poorly diversified. In late 2014, the price of a barrel of oil basically began its descent from $100, and that price got halved, and it really has not recovered since then. We have a loss in population. We have a loss in jobs. These things are so important and fundamental to the economics 101 of supply and demand. However, paradoxically, you think of Alaska as this huge state, this huge place, and it really is. The big joke is if you divide Alaska in half, Texas would not be the second largest state, it would be the third largest state because each half of Alaska is larger than Texas. But the paradox is here in Anchorage, we have a land shortage. And the remaining availability of developable land is a significant input to the value of a property. Anchorage, the city of 300,000 people, is wedged between the mountains and the ocean. So it's actually helped keep prices buoyant here. To get anything to cash flow, you can get properties to cash flow, but you really need a fourplex or greater property in order to get the economies of scale. So the numbers just don't work as well as they do in Greg's market of Jacksonville, Florida, for example, where you can get maybe a little cash flow from a single family home or a duplex there, but that doesn't work here. But it all comes back to that economics 101 of if your tenant doesn't have a job because oil jobs have dried up, because companies aren't profitable anymore, then you don't have a tenant in your property. So we can't overlook that. The market is more important than the property. That's why it's actually a poor place to invest, in my opinion, in Anchorage, Alaska.
Something you mentioned there, that the market is more important than the property, is 100% true. Right?
Yeah.
So many people go about it the wrong way, and they say, well, I think I want to own some rental property, so let me look out my front door and see if there's a rental property in my neighborhood. Meanwhile, they may live in California, New York, or Virginia, or Alaska, and think that that is the right market to be in. And quite frankly, many times the dynamics of those markets just don't work because you have high prices and you have low rents and you can't get positive cash flow. So I think you're such an incredible authority and figure to have on our show here because you have influenced literally thousands of investors to make decisions by listening to your podcast, but you also work with a select number of markets out there, Jacksonville being one of them, but there's other markets out there. And so I think you could really shed some light on how to help one of our listeners to choose the right market for themselves. What would you say to somebody who asked you that question?
You said it. The market is more important than the property. In fact, I've somewhat been known for telling people that are all enthusiastic about real estate investing, stop looking at property. Just stop. Just take a step back. You listen to how real estate pays you 5 ways, you're using other people's money. And when most people think about becoming a real estate investor, they think about that property. They think about that blue duplex that they drive to both ways to and from work that looks pretty and has some nice landscaping. And maybe they figure that, oh, well, I could manage it myself because I drive by it both ways, and they let emotions get behind it rather than the numbers. Emotions don't have a place in income property investing. They might in choosing your primary residence. You've got to pull back and think big picture. You're not being very strategic. You're being pretty arbitrary if you're driving by a building that looks pretty because the shrubs are just cut and it's freshly painted both ways to work. think big picture, get strategic. A lot of real estate investors have a bad experience with real estate because they bought that blue duplex and they don't know anything about the vibrancy of the job market, and they're managing it themselves. And it probably isn't profitable because they weren't strategic. The market is more important than the property. In fact, in real estate investing, the reason I tell people to stop looking at property is because the property is really only the fourth most important criterion to you as an investor. First, you, the viewer, the listener, need to get inside yourself. Ask yourself, what's important to you? This investment won't work unless it works for you. Do you want cash flow, which is that passive income, which is a common answer? Or are you looking for appreciation? Are you looking for tax benefits? Are you looking for a property that even has some lifestyle benefits that you might want to use yourself? What do you want real estate to do for you? So once you're aligned on that, the second most important thing is the market, with what we're talking about now, the economic vibrancy of the market. Does in-migration exceed out-migration? Are the landlord and tenant laws in that area, in that entire state, even conducive to you such that you could evict a non-paying tenant in a reasonable period of time? What are those market drivers? Is there a good diversification of market drivers in that economy? To use Jacksonville as an example, you've got good in-migration there. You've even got the influence of the port there in Jacksonville, which provide a lot of blue-collar jobs for renters. So, Jacksonville is generally a good, vibrant market. And then the third most important thing, after the market being number two, is that team of professionals that you surround yourself with, especially that property manager. So think about it. Now that you're aligned and you're strategic on what you want real estate to do for you, firstly. Secondly, you've selected the right market. And now thirdly, you have a competent, vetted property manager. Think about how ready you are to go have the fun of buying property and put properties in your portfolio, the property being the fourth most important thing. Now you're ready. Now you're strategic. Now you're well thought out. Now you have a fantastic sense of how you can be a success. So stop looking at property. Look at you, the market, and the team first.
That's amazing, Keith. Can you break down? Well, first of all, we're coming up on the half an hour mark. Sometimes people drop off here after half an hour. So I just want to encourage people to go to getricheducation.com, encourage people to check out the Get Rich Education podcast. Doug in our group that was profiled here before said, what is it? Episode 6 changed his life. I think that is a fan favorite for everybody that helps everybody understand things very, very well. I very much want to encourage that. Also, anybody that is lopping off and hasn't gotten their question answered or want to get a more specific real estate question in, join us on Thursday. It's a great time. We would love to have you. And as we move on here, Keith, I just want to ask you, so now that you have delineated all those things, can you then tell us about the different real estate markets, how you see them? Like, what do you look for specifically when you're investing from a market?
I think about it like an economist when I approach it. Economics 101 is supply demand. Demand needs to meet or exceed supply. Florida is the #1 net in-migration state in the entire United States for 2019, which is the last year that we have complete data for. That's not on a per capita basis. You have more populous states than Florida. On an absolute basis, Florida leads in net in-migration. So when you do buy a property, you're really not so much buying the property for the tenant that's in there now. You're purchasing that property having a reasonable expectation that 18 months, 24 months down the road when that tenant leaves, that another one is going to be able to come in and occupy that property. And when you have net in-migration of, I think it was over 300,000 people last year to Florida, you have a great chance that that's going to continue to happen. I look for what I think people that are migrating really want. It's not about what I want. Most don't want to go see an Alaskan glacier and live in the dark for 5 months during the winter months. They want to move to a warm place like Florida. They want to move to a low-cost place like Florida and much of the southeastern United States. And those places typically have a lighter tax burden as well. More people are leaving for tax reasons and considerations. Now with COVID, you also have within certain metro markets this de-densification process of people moving out of central business districts and into more places like single family homes. So it's those sort of trends, those sort of markets, and they generally correlate with being in the Midwest and South where you have the numbers that work and you get that high ratio of rent income in proportion to a low purchase price. That's what we want.
All right, beautifully said. Beautifully said. So can you tell us the 5 different ways that real estate pays for you? Can we go into that?
I can, and we really get into some numbers here, but this is really cool. Like, this is why we're doing this. I mean, you learn about real estate investing, you're like, yeah, well, what's my ROI? Like, what kind of return do I actually get out of that? And it's a paradigm shift. It goes back to thinking differently and not being your average investor. How does your average investor think? Your average investor thinks on a capital gains basis. And that's not a terrible thing, but that typically correlates with the stock market. Stock market investing, mutual fund investing, ETF investing. Typically, in order to be a profiteer there, you need to buy low and sell high. And there's something else called dividend investing. You might have a dividend paying stock, but the average dividend paying stock in the S&P 500 only yields 2%. So it's pretty much a capital gains play. Well, it kind of sounds easy to buy low and sell high with stocks, which is really the main way you profit. That's harder to do than one thinks. What happens when a market goes up and an investor has been on the sidelines? What happens as the market goes up is this person that's thinking about investing in a stock or a mutual fund, they continue to see that go up, and it gets frustrating, and they get this feeling of missing out, and they feel like there's some momentum behind this market that's rising, and they begin to get bathed in this media bath, and they see that all their friends are making money, and they really have FOMO and fear of missing out, so they buy high, which is exactly the opposite of what you're supposed to do, but they justify it for all these reasons, driven by that emotional fear of missing out. And then stock markets top out, and they continue to go down for a while typically. And then feelings of discouragement get in there. And as the market continues to go lower and lower, as they're hoping for a capital gain, oftentimes when the market nears the bottom, that investor is just so discouraged, they're so tired of losing money that they sell. And they sell, rationalizing on the emotional reason that at least I have certainty. At least I'm just certain I'm not losing money anymore. That's the one piece of certainty I can get by selling. So what has this investor now done? They have bought high and sold low, which is exactly the opposite of what you're supposed to do. That's why capital gains investing is so seductive, and that's why it's difficult to get a good return. But like you brought up, Pablo, with real estate, you often have 5 simultaneous profit centers, not just a capital gain, or with some stocks, not just a capital gain and maybe a small dividend. So if you're ready for me to throw some numbers around, this is really cool. This is where we add up what your year 1 ROI is from a piece of rental real estate where you use a small down payment.
I think we are ready for it. Keith, I think you've been priming the pump pretty good right here, man. I'm pumped.
Yeah, so the 5 ways you're paid is, this means that you have 5 ways: appreciation, cash flow, loan pay down made by tenants, tax benefits, and inflation profiting, which I touched on earlier here with Greg. You're paid 5 ways. So let's explore these. The easiest way to do it is with a simple example. And yeah, there are a few numbers flying around here, but you know what's interesting with numbers? Numbers get a lot more interesting when we put a dollar sign next to them. So put a dollar sign next to these numbers. That brings interest. And we're not just talking about anyone's dollars. We're talking about your dollars here. So that's what makes the example interesting. So we need to keep it simple. So just say you've carefully purchased a $100,000 rental single-family home where the rent income exceeds the expenses. Yes, you can still find these in the United States. If that's kind of small time for you, this is all based on ratios. You can just 10x that or 20x that or whatever you want to do. When you make a 20% down payment on this 100K property, that leaves you with an 80K loan. The property is already tenanted. So the first way you're paid is typically, just generally, again, over time with appreciation. Your property appreciates from 100K up to 106K. That is just commensurate with real estate's historic appreciation rate. That, frankly, doesn't sound very thrilling, 6%. So what? Until you realize this, your $6,000 gain, that's based on your down payment of only $20,000. That magic of leverage, 6K divided by 20K, that's 30%. Now your leverage light bulb goes on. Well, wait, how did you get a 30% return from 6%? Like, how did that happen? That's because you achieved a 6% return on both your 20K down payment and the 80K that you borrowed from the bank. That 80K borrowed from the bank, the return on that goes to you, not the bank. Now we're talking about the benefit of using other people's money, like I touched on before. You got a 30% rate of return. We've only talked about the first of 5 ways you're paid. If you can follow that, you can understand the other ones, because the second one is cash flow. Cash flow, that is your rent income minus all of the monthly expenses. Let's just be conservative. Let's say that only gives you $100 of residual income. Again, not that thrilling in itself. That's $1,200 a year of cash flow, and that's still divided by your same 20K of skin in the game. That is another 6% return. So we now have a 30% return for you from leveraged depreciation and 6% from cash flow. And by the way, that 6% cash flow portion, that's known as your cash on cash return. That's what that refers to, your annual cash flow divided by your skin in the game. The third way you're paid is with what I like to call your ROA, your return on amortization. Your tenant pays down your loan for you. That's a benefit that you don't have in your own home because you had to work to go pay down the principal balance on your mortgage, but your tenant does that for you here. So at a 5% interest rate on a 30-year mortgage, that's more than $1,000 that the tenant pays down for you annually, and that's still divided by your 20K of skin in the game. That's another return to you of 5%. The fourth of 5 ways is real estate investors get all the tax benefits. And I'm not going to get into all of them because it gets to be too many numbers. So we're talking about benefits like depreciation that you can typically use as a write-off against part of your rent income. With 1031 exchanges, you don't have to pay any capital gains tax. I've legally never paid any capital gains tax in my life. There's something that Trump helped introduce called bonus depreciation. We're not going to get into all that. We're just going to call this big lump a 5% gain to you from the tax benefits. I know that's kind of hazy, but there's a lot going on there. We just don't have time to delve into all that. And then the fifth and final way, this is that one that even some advanced investors fail to consider. Just like you wouldn't keep $1 million in the bank, that would be a bad idea because inflation would erode its purchasing power. Oppositely, when you borrow, inflation helps you. If you borrow $1 million, it's just a 3% inflation rate. You only owe the bank back $970K after year 1 and $940K in inflation adjusted dollars after year 2. So inflation erodes the weight of your mortgage debt balance just the same. And a lot of investors don't understand that. Billionaire with a B, real estate investors don't even understand that. So, I mean, let's do it. This is the cool thing. Let's add up all 5 ways that you're paid. We said you had 30% from appreciation, 6 from cash flow, 5 from your ROA, your return on amortization, another 5% from tax benefits, and 3% from inflation hedging rather. And your year 1 return from this income property is a whopping 49%. 49%. And maybe you think, oh, well, that's got to correlate with some high flying risk, or what are you doing? Some no money down strategy that you learned on an infomercial? No, this is just buy and hold real estate investing. You know, that's all it is, of residential property, of something essential that a tenant needs.
I like it, my friend.
Yeah.
I like it. You know, for the first probably 3 months or 6 months of the show, I'm so focused on the cash flows that Pablo is asking me questions. Other folks are asking me questions. You know, okay, what are your expected returns? And our expected returns just on the cash flows are 9 to 11%. And so the moment that Pablo asked me to break it down and to include all of the different profit centers, you know, the numbers, they went well over 20%, up to 49%, like you're talking about. Very believable, right? And his mind was like, dude, why you been holding back on me all this time? He's like, and I'm like, well, I probably could have done a better job of explaining how impactful all of those profit centers are. And the big thing is that this is a normal, readily available, like JWB property or a turnkey rental property with a reputable provider. This isn't that stock that is that, you know, unicorn that has to do well. This is readily available. And then when you're comparing it to what you explained in the stock market too, the thing that is also readily available that you do not get in the stock market is the ability to use other people's money, right? The ability to use other people's money and borrow at 4% in today's environment is an incredible tool. Quite frankly, the numbers would not look nearly as good at what Keith was just talking about there if you had to do it all in cash, right? But because you can use other people's money responsibly in an asset with low interest rates, like 4%, in an asset where it pays for itself every single month, it's not a liability for you, is what makes this such a beautiful asset class, and why making debt such a tool to help you create wealth. So I think you did a great job, my friend. I think we should just package that up and just replace me every time I'm explaining that and what Keith said right there.
You bring up a good point about it being readily available, because you don't need to be what the SEC defines as an accredited investor, which is, you need to have a certain amount of net worth or savvy. You don't need anything like that. I do want to talk about some limitations too. In that example, we did not factor in your buyer mortgage loan closing costs, but the seller can often help you pay those. And there is still risk. If you buy a property in a losing job market, or you hire the wrong property manager, your investment could go south. But when you're paid 5 ways, even if 1 or 2 of them completely dried up and evaporated, you're still paid 3 or 4 more. Even if 1/3 of things went wrong, you would still have about a 33% return based on that 49% that I just came up with. And I also do want to note that your return does gradually go down in future years. If it were 49% in year 1, it might be 37% in year 2 and 29% in year 3, or something like that. And the short story there is because equity accumulates, and the return from home equity is always 0. So these are some other caveats to keep in mind, but this is really important stuff. I mean, this is keeping score. A lot of investors are actually winning when they think they're losing, and others are actually losing when they think they're winning, because they just don't know how to keep score. But now you know how to keep score, and you understand all of the profit centers. And this is huge, because when you know where your returns come from and you know how to calculate your ROI, now you know what to buy, now you know what to sell, now you know when to sell, now you know when to do a cash out refinance or a 1031 exchange. So it really comes down to understanding how you're paid. And this right here is exactly why real estate's made more ordinary people wealthy than anything else. Building your compelling why.
Hey, Keith, got a question for you, my friend. All right. So I did some research because, you know the numbers well. I know the numbers well. But when I talk to other people out in public as well, people generally are bought into the concept of owning real estate, And so at some level, while they may not understand it as well as you explained it right there, people see that from a return perspective, it probably performs better than other alternatives. So I looked up some research on it, and according to a Gallup poll, they asked Americans what was the best investment in their portfolio they felt for the long term. If they could choose any asset class, what was the best one in their opinion in the long run? And the vast majority of Americans chose real estate. It was 35%, and then so on and so forth. Stocks were 20-something%. Bonds were like 4 or 5%. But then they asked them one more question. They said, all right, in your actual portfolio, what percentage of you actually own real estate?
Yeah.
And it was the 5th most popular choice.
I'm not surprised. Yeah.
Behind bonds. And so I've always tried to understand this. Why is this phenomenon happening? Why do you think that is?
It's because knowing and doing are 2 very different things. Think about all the people out there, Greg and Pablo, that are not at their ideal body weight, but they know what they have to do to get their ideal body weight, but they're not there, and some never get there. It's just simply because knowing and doing are 2 very different things. If someone says it's all about mindset, I disagree. It starts with mindset, but it's not all about that, because really not, Sir Francis Bacon said knowledge is power, but I think a lot of people have since improved on that. Well, it's knowledge plus action is what's giving you power. And maybe with the 5 ways you're paid, that's enough of a compelling why to help initiate action. But the short story is knowing and doing are 2 very different things.
Makes a lot of sense. And when people see something as difficult, it makes them less likely to do what's in their best interest, which is why I think what JWB is doing of making it as frictionless, as easy to invest in something like this when you already know it's good. That's kind of like taking the vegetarian plate and packaging it inside of a Doritos container or something easy that you can take on the go,
Yeah.
right? Like, yeah.
I like that. That's our new tagline. Invest with JWB. packaging vegan appetites in Dorito containers in real estate. Nailed it.
I don't think I'm going to see that at the top of your website anytime soon. But Pablo brings up a really important point. This can be daunting for some people. You need to do things like, in order to get this desirable debt, you need to qualify for a loan. You might need to learn some things about getting your credit score where it needs to be, or getting your debt to income ratio where it needs to be, so you can get a mortgage loan for an income property at the best rates and terms. And like a company like Greg and JWB, you operate on a turnkey real estate investing model, which is a great way for people to get started. If real estate investing sounds compelling to you, but you really need someone to maybe help hold your hand, turnkey real estate investing, what that means is that, like Greg and JWB, like they have properties there, which is why I refer my followers to Greg's company, with properties that are already tenanted, already completely renovated, or typically brand new construction in his case, and already under management from day one. That's why it's called turnkey. So a turnkey company helps hold your hand and make it approachable for everyday people.
Yeah, that's awesome. I mean, I'm suffering from major FOMO of not having real estate right now, and I'm not the only one, right? So we have John Aclaggy here in the Facebook group. He says, "Good afternoon, Mr. Weinhold. Could you explain buying properties with low income but a high credit score as a college student? So if you were in college right now, you don't have a lot of income, how would you go about but you have a high credit score, how would you go about investing in real estate properties?"
I would still try to do it longer term, but I think you're asking in the immediate term, like, what do you do now if you don't have a lot of money, or you don't have a 20% down payment for a $250K property, which would be $50K plus closing costs? Like, I get it. I've been there. And what I did is like, well, what can I do now with what I have? It was, for example, buying that fourplex building in Midtown Anchorage, Alaska, where I lived in one unit, rented out the other three. It was a $295K purchase with just a 3.5% down payment on an FHA loan, which is a program that still exists today. As long as you're in the United States, you can get that 3.5% down FHA program as long as you live in one of the units for at least 12 months. The owner-occupied fourplex, where you live in one unit and rent out the other three, has got to be one of the best deals out there that nobody knows about. And you can use this program with either a single-family home, duplex, triplex, or fourplex, but not greater than a fourplex. But that's how I was able to amplify my wealth, amplify my good debt, and do it without a lot of money. So again, it's called the FHA, Federal Housing Authority 3.5% down program. And if anyone out there has VA benefits, Veterans Administration benefits, you can get that same deal I just described with 0 down payments. So that's a great way to start with a bang and a small down payment.
Excellent. Easy peasy, John. Now you know, man. So, Keith, I would like to switch gears a little bit here, right? Because I am fascinated by the idea that you started a podcast in 2014. That's way ahead of the curve. I would love to hear about how you decided to pivot into this new frontier, how you saw it coming, and how you've grown such a big platform to have where you speak to 3 million people. I think it's outstanding.
I probably did start the podcast at the right time. Not very many people had shows in 2014. And, again, it's all about not being average, not doing average things, not making average decisions. Maybe for a person looking to share content today, that's finding, now, where can you be the pioneer in the next frontier? Maybe that's with something like voice activated technology through Alexa or something like that. Yes, it is true. I began the podcast in 2014 with a $60 USB microphone plugged into the side of a laptop from an Anchorage, Alaska dining room table. And I think some of the best advice I ever got on podcasting was speak clearly and with authority. People want clarity in their life, especially with something like real estate, where there are quite a few moving parts. So if you can make something clear and easy to consume, like an app on your phone, it can be a pretty good way to build a following. And I do have to tell you, since I am based in Anchorage, Alaska, I was a little concerned when I started. I'll just get vulnerable and tell you, because it does not exactly sound like the finance capital of the world.
Right.
But I soon learned if your content's good, it just really doesn't matter where you're at. And one of the smartest real estate investing philosophies is live where you want to live, but invest where the numbers make sense, which is often elsewhere. And really being based in Anchorage has been a credit to that. I truly live where I want to live, and I invest where the numbers make sense, which is elsewhere.
And what has well, first of all, so Doug is clearly a fan of the show, right? He says, off topic question, what is your favorite plant to eat out of your backyard, since you often post pics of yourself eating your plants?
Not much grows in Anchorage. It's either rhubarb or raspberries. That's all we got. We just picked raspberries for the first time yesterday. The high temperature often doesn't even hit 70 degrees here in the summertime. So yeah, if I had to make a meal out of what was in my backyard, I'd be dead in about 36 hours. But we did have some raspberries back there yesterday.
Oh, okay. So I think he's referring to the moose. You have a moose in your backyard?
Oh, I see. Yes, a city of 300,000 people here, Anchorage, Alaska. We do have moose that just walk around, wild moose. It feels very much like the suburbs where I live, like we're on quarter-acre lots. But yeah, moose walk into my backyard and they eat my wife's flowers and they trample her bushes and everything like that. So it's just part of this paradox of being in a city of that size, but yet being that close to wilderness.
That's incredible. So Keith, tell me about, now that you have this massive audience, right? You've created this impact. You have people like Doug is not the only guy that thinks you've changed his life, I'm sure. And you hear this back, right? What is the impact of creating this educational platform and being able to leverage relationships through it? What has that impact brought to your life? Do you have like an anecdote about that, or a general feeling on the RO influence, right?
Yeah, I do have something I can tell you there. And by the way, hello to Doug Orr. I can't see all the questions that are coming in. Douglas Orr is one of our longtime listeners, so I had him as a guest on the show a couple years ago. This gets a little touchy-feely, but my wife and I don't have children, and I don't really have the next generation to kind of pass along some of these ideas or concepts to that I talk about that can really impact others, like don't live below your means, expand your means. Like look at that difference that can make in your life when you follow that, and operate with ethics and be a good person. For example, as a real estate investor, own property that's clean, safe, affordable, and functional. Doing the right thing is more important than doing things right. I don't have children to pass this on to. I have my audience to share this with. So it is pretty touchy-feely, but it's really what gives me the greatest sense of significance in my life. And there's just nothing else that can replace that. That's what keeps me showing up every week to do the show with so much energy. So it really is about that impact.
That's beautiful, man. First of all, I want to encourage anybody to go check out your podcast, Get Rich Education. Go to your website, getricheducation.com. I'm a very big fan of the idea that we can all leave a legacy. We can all put the things that we're learning out there and the way that we're growing through life right now. We can put it out there into the world and put it onto the internet through content and what you're doing, and affect change for the better at scale. It's amazing. So you are a testament to that. It's been an absolute pleasure to speak to you today. I want to thank everybody for being here. I want to encourage people to go to jwbwebclass.com if they want more basic rental income property investing 411 and understanding how the whole thing works and how to work with JWB. Join us on Thursdays for the Not Your Average Investor Show Thursday Q&As, where it's just me and Greg. I think Greg sometimes sings. I think he did that last week, and maybe this week you rap or you bring in a musical instrument. I don't know. I'm not gonna give it away.
You're taking the rap. You got that.
I'll take the rap if you drop a beat, but
I'll dance.
So somebody just needs to ask the question. But listen, without further ado, I just want to give it up to Greg. Also, if anybody has a specific question to add rental income properties to your portfolio, go to chatwithjwb.com. If you want to take that next step and just find out what you have, what's available, things like that. I encourage you to do that. Great use of your time. But I always like to give it up to Greg for the last word here.
Yeah, what an incredible episode, Keith. I think back about when our relationship started maybe 3-4 years ago, and I think we had been introduced by a mutual friend. We had both probably talked. You'd probably talked with a number of turnkey operators, and I had talked to a number of podcasts or affiliates or marketers out there, and I said, oh, geez, well, here's going to be another one. I'm sure you probably said, well, okay, I'll talk to this guy, Greg, but he's probably going to be like everybody else. And I just remember from our first conversation really hitting it off and understanding that, you know, for you, it was a lot more about building this long-term relationship with a company like us. And for me, that's all I really cared about, right? Because we're both approached by a whole bunch of people in real estate who create more noise and more challenges than benefit, in my opinion. And that wasn't you from the very beginning. You really came across as a humble, authentic, genuine individual right from that very first conversation. And that was 3 or 4 years ago. And we've done nothing but just enjoy working with you and your team. The fact that you came and you invested in our relationship, you came down to JWB and walked through and was able to give you the tour meant a lot to me. And now having mutual clients now built over 3 or 4 years is just, it's one of the relationships I value most here at JWB. And I really appreciate you. I appreciate you being on the show here and dropping some knowledge with our listeners. It just happens to be right in line with the person that I know you are. And I'm excited to grow both of our businesses together for many, many years, my friend. Thanks again.
Thank you. Talking about this stuff fires me up. I think I'm leaving with more energy than I came in with.
We love to hear that. We love to hear that. So thank you, everybody. Have a great week. We'll see you on Thursday. And until then, don't be average. Be not your average investor. Right, Keith?
That's right. I love that name. Bye-bye, everybody.
Bye-bye.
See you, everybody. Take care.